Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 4th of November. I'm Daniel Lam, your host for the podcast. With risky assets performing very strongly so far in 2025, where are the pockets of value for investors? Well, yesterday we spoke about our new opportunistic idea in fixed income, i.e. the Asian dollar IG bonds. The fundamentals are strong and the spread is likely to be staying tight. Technical factors are very supportive. So for example, there is negative net issuance, i.e. new issuance is not keeping pace with the speed of maturity or redemption. And as we know from our Economics 101, if demand stays intact and supply gets less, then it is a good tailwind for the prices. For equities, the most interesting new opportunistic idea is the gold miners. They are a higher beta instrument to express a bullish view on gold. To recap, the current pullback in gold represents a buying opportunity and we're staying overweight because the structural drivers of gold rally is still intact. So for example, the geopolitical uncertainty leading to EMs consistently boosting their gold reserves in the past 3 years, especially after the US and the EU decided to freeze Russian central bank assets following the start of the Ukrainian war in early 2022. The top 3 EM central bank gold holders, China, India, and Russia, have 6.7%, 13%, and 36% of the reserves in gold. Secondly, concerns about expansionary fiscal policies worldwide and the US fiscal policy, and that can hurt the US dollar. So the Tax Policy Center estimates that the One Big Beautiful Bill would add $4.2 trillion to the federal debt, or 9% of GDP by 2034. And finally, there's increasing questions about the Fed's independence. So the gold miners, in terms of fundamentals, are enjoying the expanding profit margin because the rise in gold prices outruns the increasing cost. This leads to surging free cash flow, which enables companies to be increasing the share buyback, to raise dividends, or to pay down their debt. All of those improve the fundamentals of the gold miners. Another new opportunistic idea is US pharmaceuticals. Their valuation is inexpensive versus the broader US market, trading at close to 1 standard deviation discount in terms of relative 12-month forward price to earnings ratio. Its main headwind is the regulatory uncertainty, but that risk is receding as pharma companies are agreeing on pricing and tariff concessions with Trump. Lastly, we initiate a new opportunistic idea on US utilities, which also offers defensive earnings growth and reasonable valuations. Earnings growth is accelerating with the data center boom supporting electricity demand growth over the next decade. And the US electricity demand can grow at twice the pace over the next decade versus the previous ones. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.